When it comes to investments, everyone wants to pick the best one. How do we outperform our friends? How do we do better than everyone else we know? And most importantly, how do we outperform the market, right? Well, if you choose your investments the wrong way, it will cost you hundreds of thousands of dollars over your lifetime. And no, I'm not exaggerating. We see it all the time. People with terrible selections that have cost them thousands, hundreds of thousands of dollars, and all because they did not have a process, a framework for how to choose their investments. So that's what we're going to cover today. How do you choose your investments, especially if you're getting close to or in retirement? What is the best way? How do we know which ones to choose? If there's so many out there, right? It's like shopping at in Amazon. There's just so many choices. How do you know what's the best one to choose? My name is Freeman Lindy. I'm a certified financial planner and tax expert, author of a couple of best-selling books, and today we are going to cover how do you choose investments. And no, I can't tell you exactly which investments to choose because that would be investment advice. And this show is not investment advice. I'm not your financial advisor unless I am, and you actually come work with me. But otherwise, this is not investment advice, right? This is education. We're going to give you, instead of telling you what to choose, right? Which then you listen to someone else and they tell you what to choose, and you make one of the biggest mistakes, which is to keep selecting different investments all the time, right? We cover that in this book here, The Four Horsemen. One of them is chasing returns, where you're constantly switching investments, trying to get the best one, which leads to terrible long-time performance. So I don't want you to do that. And so if I just tell you this is the investment you should choose, then the next time someone tells you this is the investment you should choose, you're going to go after them instead, right? And you're going to keep switching and you're going to lose. So instead of telling you which investment to choose, I'm going to give you a framework, a 7-part framework for how to choose investments so that you can be confident in what you have. It's the same way that I choose investments for my clients. So we're giving away the goods here today. So first of all, we want to cover, like with many things, so much of financial excellence, of financial success is not in what you do, but in also what you avoid doing. So first, let's cover how not to choose your investments, and then we can jump into the framework for how we should choose them. So a couple of things, let's look at 3 ways. So three ways not to choose investments. Okay. Number 1, right? Past performance, right? You're looking at different investment options and choices, and you're saying, hey, what do I pick here? What do I pick there? And you're trying to evaluate. And so where this comes in most frequently is in like your 401k, right? Most of us have a 401k if we're still working, and you've got 20 choices in there that you could choose from, and you're going through the list. You're like, how do I know which one's best? And right next to all those choices, right, you're going to see, you got the different tickers in there, and you got this one, and you've got this one, and all these different ones, right? And then next to it, you've got 1, 3, 5, year returns, and maybe also let's give us some more space here, 5, maybe some 10-year returns, and then a since inception, right? And there's different numbers for all these going all the way across. And you're like, which one do I choose across all these different ones? And so what people do is they'll just, like, the worst thing you can do is you look at, hey, what's had the best return this year? And you just pick based on whatever has the highest return. That's the one you choose. Let's pick that one. And terrible idea, right? Because they're going to fluctuate. And just because something's done really well last year doesn't mean it's going to keep doing that. There's no evidence for the persistence of performance. Just because something does something good in one year doesn't mean that will continue. It may have gotten lucky. It may have happened to have lucked into a few good companies, and that drove most of the results. So we don't want to do that. The more sophisticated people will go out further this way and choose, well, hey, let's look at 5-year returns. Or hey, we're going to go really sophisticated and we're going to look at since inception returns. And actually, I would say that out of all these different ways, comparing since inception returns is the worst way to pick investments. And here's why. Let's say that you're looking at the stock market, right? And you've got we'll go up here maybe. Market does this, you got a big downturn, and then it's come back up, making some all-time highs. Okay. You could have 2 funds that are identical, right? One started here, right? And so it started right before the market went down, came back, and now we're here, right? Well, that means you have this average return. That's your annualized return over the since inception date, right? You had another fund that started here, which means that its since inception rate of return looks like that. And they could be actually identical funds, have almost exact same the way they're built inside. And this one might have a 6-year or 6% a year average return, and this one might have a 12% a year average return. And you're like, well, this one's way better. It literally has double the return. But they started off at different points, and that's literally the only reason for their difference. So never, I can say this with confidence, never choose your investments based on since inception returns. Literally the worst way to do it. If you're going to do this at all, you want long track records, 10 plus years, of how well did this do, right? Now, how many of you want your investments to live longer than 10 years? Me for sure, right? Because I'm planning to live longer than 10 years. I'm planning to be retired longer than 10 years. And so even for me, 10 years is like a starting point, right? We want funds, we want things that have a track record of 20, 30 plus years of results, not just 10. But oftentimes that's all you can do. So bad ways to pick investments. Number one is past performance, especially short-term past performance or since inception past performance. Number two would be your star rating, right? You go on Morningstar or whatever else, and this fund has 5 stars, and you're like, yeah, that's awesome. Problem is, the star rating is pretty much all just based on past performance, with a weighting towards short-term past performance. So we're right back to the same. Don't do it. Third way is, hey, we think that this is going to be the next awesome, flashy, exciting new investment. AKA, we're just speculating. And so, we hear some company goes public, some hot new fund, whatever else. Don't do any of that, right? Again, if you're going to do past performance, right, we want things that have a long track record of great money generating activity, right? So that is how we want to choose our funds. Now, so those are 3 ways not to choose it. How do we actually pick our investments, right? Let's get some more blank space out here. And so this is here. Let me give you a framework. This is how we should choose our investments. Number one, see where we're at on the thing here. So 1, what is the goal? It's really that simple. Begin with the end in mind. What are we trying to achieve here? If you don't actually have a goal in mind, then I can't tell you what investments to choose, right? Because there's going to be a big difference in the way we invest if we're investing for retirement, which is 30 years out, retirement, which is 3 years out, the end of our life, which is 60 years out, college for a grandchild or child, which is 2 years out, trying to beat our friend or trying to have the best performance last quarter with our buddies at the YMCA. Like, what are we trying to do here, right? Because if you're trying to outperform someone over a quarter, that's going to be much different than, hey, we're trying to build systematic wealth, or we're trying to generate a retirement income that outlives us and everyone we care about. And so you need a goal. And without a goal, you can't invest. Not truly. So begin with the end in mind. What is your goal? And it might be, okay, so let's use the example of, well, I'm trying to grow my nest egg to the size where I can live off of it for the rest of my life. Great. Then number 2, you need a plan. What is our plan for achieving that goal, right? Not just the investment side, but the tax side and the insurance side and the cash flow side and all these other things, because investments are just part of a plan. I'm just going to jump right into number 3, right? We would then choose a portfolio, because at the end of the day, portfolio, there we go. A portfolio funds the plan to get us to our goal. That's what a portfolio is for. It's literally just a funding mechanism to do everything else that we want to do. And so if we don't have a plan, then there's nothing to fund. And if we don't have a goal, we're not working towards anything. And so we need to start with the goal, then a plan. How are we going to get there? How are we going to incorporate the other things? And part of the reason this matters, right, is if on a timeline, we're working, we're making X amount of money, then eventually that's going to drop off as we retire. And we want to still, let's do this with our, we still want to spend this amount. We are working, we're earning this amount. That's going to drop off at some point, but then it's going to be replaced by, let's say, Social Security here. And so we have that big chunk of of Social Security that's going to add to our retirement income. And so we need to invest and we need to plan to make up this amount per year in expenses. Great. Well, that's different than if we were waiting for Social Security and we're going to wait till this point and it's going to be this amount. Great. It's going to be higher for life. That's awesome. But now that means that we need to fill in all of this for longer and then this for shorter. And so where the total plan, not just the portfolio, but the total plan, how everything else interacts, is going to dictate which investments you should choose. And so we need a plan, and then the portfolio funds the plan. Okay. Then inside that portfolio, the next thing we want to know is our asset allocation. Okay. Which is just a fancy word for which percentage do we have in equities? Maybe it's 50% in there. And what percent do we have in bonds? Maybe it's 50% in there. Or maybe our asset allocation is 60% or 80% fixed income and 20% equities because we don't like equities and we don't like the volatility, or at least we don't like the downside of the volatility. Or maybe our asset allocation is 80% equities because we love to ride the roller coaster and we love that growth, and only 20% fixed income, right? However you're going to choose that, whatever combination of these things we have is going to dictate what investments we choose specifically inside of there, right? So we need to decide, and I think I need an N on the end of there. There we go. We need to decide how are we going to invest that between the different asset classes, equities or stocks, fixed income, bonds, CDs, treasury bills, things like that. And then, of course, real estate could be in a separate asset class if you wanted to consider that, things like that, right? So what's our asset allocation? Then, we still haven't got to the actual picking of investments yet, right? But then number 5, I think we're on, right? Number 5 is we need to decide our diversification. Diversification, there we go. Which is, hey, inside of our equities or our fixed income, what are we like? What's the breakdown inside of there? So let's take equities for example, right? Let's say we decide that we're going to be 75% equities. Okay, how does that break down between? And you could break that down between, if you use the Morningstar boxes, you have large and small companies with medium in the middle, and then you have growth on one side, which is companies, they just reinvest all their profits into getting as big as they can, or you have value, which tend to pay out more of their profits as dividends, right? Where are you going to be? How much of each do you want in each of these boxes, right? Because they all kind of travel together, but their humps might come at different times. And so a real good example of this was, if we take, large growth and large value, right? Last couple of years, large growth has been real good. But when 2022 came and, the Russia invaded Ukraine, inflation kicked off, all these things, market went way down, kind of bottomed out at minus 25% for the S&P 500, came back up and hit all-time highs, right? Whole thing took about 2 years and a week for the S&P 500 to go down, come back up. Well, inside of that, we have large cap growth, which went down to, I think it was like 30% down, minus 30 before coming back up, right? Basically it took 2 years to come back to even. But large cap value went down minus 2 and then it was up plus 9 the next year, right? And so some of this matters again, where are we at in the plan, the portfolio, all these things, because if you're 10 years out from retirement, and again, our goal is 10 plus years out, this doesn't really matter, right? If you go down a lot and come back, it doesn't really matter. But if you're in retirement and you need to be pulling out, well, then you're going to want to have both, right? You may have had better returns over the last 5 years having your money in large cap growth. And if you knew that on the front end and you were prescient and had a crystal ball and you knew which one was going to outperform over the last 5 years, great. Then you can do that. But for the rest of us mortals, since we didn't know that in advance, it's good to have both because they've both done really well over long periods of time. But it's nice to have, hey, if one's going to be down 30, it sure is nice to have one that's only down 2. Especially when, large long-term bonds were down also 30 and have still yet to come back. So your safe bucket wasn't even safe But we had another equity bucket, which only went down 2%. So if you needed money, then you had money to pull from that wasn't down. Because the one thing we never want to do is to sell when the values are down. Right? It's the only way to turn a temporary decline into a permanent loss is to get out when your values are down. So we never want to do that. And so you want diversification, right? How do we spread this out across different sectors so that when some things are down, other things may be up, and vice versa? It creates a lot of different opportunities in there. Then number 6, fees. Some people seem to think that fees should be number 1, that you just automatically choose the things with the lowest fees. Nope. They are important, and if all other things being equal, choose things with lower fees, right? Because they're just a drag on performance. A good example of this is I think it's called the Ridex. I should have looked this up. The Ridex S&P 500. It's the exact same fund as the Vanguard or any other, you name it, any other S&P 500, except for Vanguard and all the other ones are 0.04% per year in expenses. And the Ridex one is 5% upfront plus 1.65% annually to be in this fund. Literally the exact same fund. How can they do that? They can get away with it. There's still hundreds of millions of dollars in that fund because you get sleazy investment professionals that just chuck them in there because they get paid a big commission off this and they get nothing off this. And then people just don't know any better. And so the returns on this are obviously way worse than the returns on this because you're paying a bunch of money. So don't do that, right? So fees factor in there, but they're way down here at number 6. And then lastly, number 7, your actual investment selection, right? So first you would say, hey, what's my goal? What's my plan to get the goal? What's the portfolio that's going to fund that plan? What's my asset allocation, my percentage of equities to fixed income? Then inside of that, right? So on the fixed income side, we decide, hey, how much is in money market? How much is in short-term, medium-term, long-term bonds, high yield, treasuries, whatever else you want to do in there. On the equity side, how much is in large cap, small cap, mid cap, value, growth, whatever else, right? However else you want to slice that up. What percentages do you want in all those? Then you would select for fees. And then you would say, okay, since I want X amount in large cap growth, now which large cap growth fund am I choosing for that? Since I want X amount in small cap value, which fund am I choosing for that? Since I want X amount in money market funds, which money market fund am I using for that? Large cap, large long-term bonds, whatever else, right? That's when you choose. But way too many people are just well, I guess I'll choose this one because it's got great 5-year returns. No, we need a framework, a plan for how to choose these, right? If you don't want to do all this work, people can help you with that, right? But you don't want to, that would be the framework of how you'd want to choose good investments that are in a plan that you can stick to and ultimately retire successfully and stay successfully retired, which is what we are all about around here. So hopefully you found that helpful in how you choose investments for retirement. Okay, now each week we look at our Stay the Course sketch, which is part of a weekly email that I send out. And if you like to read rather than watch, you can do that. But it never seems like a good time to buy. No matter what's happening, it doesn't seem great, right? And so we have this sketch. This was from a while back, right? And market's high, and we say, oh, well, the market's too high. I don't think we should invest right now. And then it goes down. It's oh man, the market's looking pretty bad right now. Could go even lower. Doesn't, comes back, right? Well, it's probably going to pull back. It's going to be a W-shaped recovery, right? We saw this a lot with COVID. Went way down real fast, came right back. We were well, other shoe's going to drop for sure, right? Now is not a good time to get in the market, right? This would be bad, right? Keeps going up. Well, now the market's too high again. We don't want to do it then. Comes down again. Well, let's wait for things to settle down. It seems a little sketchy out there. It should be a pullback at some point. Oh, it's too high again, and on and on and on, right? And so we've seen it a million times. And one of the things right now in April 29th, as we've been flirting with all-time highs again, over and over again. The war in Iran is still going on. Doesn't seem like the market should be back. People are well, it's gonna fall again, right? It's gonna pull back. It's gonna come back. The other shoe's gonna drop. Maybe. People said the same thing. COVID didn't happen, right? And if you're waiting for the news to tell you that it's okay to invest, that everything's all right, you're going to be sorely mistaken. If you're waiting for the economy to look good, it's too late, right? In 2020, during the COVID crash, right? It came back in 6 months, and the whole economy was still shut down. When the 2008 financial crisis, when the Bureau of Labor Statistics finally announced the recession was over officially, the market had hit all-time highs like 8 months before. I don't know, remember the exact time frame, but it was months and months before. And so if you're waiting for some big announcement that it's officially time, it's good time to invest again, the market will have already completely beat you. And so for us, right, it never seems like a good time to buy. The best time to buy is when you have the funds. And the best time to pull out is when you need the funds. And you want to have some flexibility in there in terms of where you take the funds from so that you never sell low. But if you've got money on the sidelines that you're waiting to invest, it's never going to seem like a good time. You should probably just do it. And if you have money that you're putting in constantly, you should probably just put it in. Because it's never going to be a good time. And I don't know how many of these cycles we need to see with how many excuses we need to not invest before we're finally convinced that we should just invest. So never seems like a good time, usually is always a good time. And hopefully that's helpful. If you find this helpful and you want this weekly in your mailbox, you can become a Retire member. Lots of free content, free gifts, completely free. You can sign up, use the link in the doodly dudes below, and love to just continue to help you retire successfully and stay successfully retired. Okay, we get questions from the audience emailed in. You can put them in the comments below if you have questions and you want us to answer them on the show. Throw them in a comment, or you can email questions@retirementorship.com. Ethan, our producer, is going to throw it up here. Justin asked, how important is a credit score? Yeah, so credit scores. So first of all, how it's made, right? What is a credit score? So obviously a credit score is how lending companies decide, hey, if we lend to you, how likely are we to get our money back? The less likely we are to get our money back, the higher interest we are going to charge you so that we can at least get as much back in interest as we can if we're not going to get our principal back, right? And so the way that they calculate that is I think it's like 30 or 35% maybe is on payment history. So how regular you are at making your payments, even if it's literally just minimum payments, which is don't recommend, especially on like a credit card, right? But do you ever miss payments? If you never miss them, you want perfect payment history. So whatever you do, always make your payments, no matter what. And then it's 25, 20%, 30%. I don't know. It's like 25 or 30%, somewhere in there, for credit utilization, which means of the total credit limit that you have, right? They say, hey, you've got a $10,000 credit card limit. How much of that are you actually using? I think one threshold is 10%. The next threshold is 30%. Like you want to be optimally less than 10% and also good as less than 30%. Anything above that and certainly maxed out is not good. Because then they're basically, hey, we allowed you to use this money and you took us up on all of it. That's not a good look for you. So we think that you're probably struggling. And so we're just going to make sure we charge you a lot of interest to get that back. And then it's like 15% is length of credit history. Hey, do you have a long history of either bad or good history? And then it's like 10% for like how many times you inquire, like hard inquiries, how much you get in general, what mix do you have, student loans, etc. So there's a bunch of like 10%. I think it's all, but the main ones are these ones, and then length of history to a somewhat lesser degree, and then a bunch of little ones. So that's how it's made, right? Now, what credit score is not good for, because there are some people, as Dave Ramsey says, that worship at the altar of the credit score, where their sole focus is on getting a good credit score. And if anyone ever mentions to you what their credit score is, they probably don't get it. Because all a credit score is, right, is how good are you at paying back debt. It doesn't tell you how financially healthy you are. It doesn't say what your savings rate is, how much you have in investments, right? You can have $10 million, right, and have almost no debt or little debt at all, but then like miss a payment and have a less than perfect credit score, and someone who's got up to their eyeballs in debt and zero assets whatsoever, but they have a perfect payment history and they're just they have a whole bunch of different credit, and so their total credit's like 100 grand, you know, and then they're only using 10 grand of it, but it's less than 10%, and so they have a perfect credit score, and they're going to think they're better off because they have an 820 credit score or whatever it goes up to, and it's not a good indicator at all of how wealthy you are, how good you are with money, any of those kind of things. Um, so it's not good for any of those things. What a credit score is good for, I would say the number one thing, let's use green for this. The number one thing that you would want a good credit score for: mortgage. And this is where I do just disagree with anyone who says, like, just have no credit score, just get rid of all your debt and have zero credit score whatsoever, because you can get manual underwriting stuff. And it's true, you can get manual underwriting for an additional, 0.5 to 1% tacked onto your mortgage because you don't have any history of being able to make payments. And so having no credit history at all, no credit score at all, I do not recommend unless you're literally never going to get a mortgage again ever in your life or any other debt. But since most people are going to get a mortgage at some point, or already have one, or refinance into one, or whatever else, having a good credit score, if it's 0.5%, 1/4%, any amount whatsoever, the difference between a good credit score and an okay credit score will literally cost you or make you hundreds of thousands of dollars over your lifetime, tens at least, right? And so one thing, because some of it's like hard inquiries and some of these other things, there are people out there who, right, they'll open up a new credit card at the Gap to get 10% off one order, right? But that hard inquiry and that the other things it does to your history will add 1/4% the next time they get a mortgage, and they'll pay tens of thousands in extra in interest to save $50 at the Gap or $10 at the Gap. Don't do it, right? Don't do it. It's not worth it. So we do want good credit scores if you're ever going to get a mortgage whatsoever again, or any other kind of debt. And some people are going to want me to say you should never be in debt. Just pay off debt. Some people are going to say you should use other people's money to gain wealth. I have a kind of a more nuanced stance, I think, on debt, because I've seen people who are debt free and love it. And there's a phrase, you don't know what it feels like to live in a paid off home until you've been there. And if you're there, you can always go out and get another mortgage, right? And so there's some people that just love it. And they'll say, once you're debt free, you will never regret it. And there's some people who are debt free and they have never regretted it and they love it. I know people who have lived that life, have gone debt free, and now wish they had kept their 2% mortgage from COVID. Just like, that's just not that great. It's like, who cares? I don't have mortgage payments. So what? Like, whatever. I also know people who scrimped and saved their entire life to die with millions of dollars and pass it on to their kids, who then just go blow it. And so, you will ultimately have more money overall if you don't use debt, don't buy things, save it all, invest it all. But to me, so here's kind of my thought on debt. Let me know if you think it'd be interesting for me to go further into this. Consumer debt is less overall, but sooner. Less overall, but sooner. And some people are like, well, hey, don't. What do you mean? What do you mean? Don't you get more? Like, you get more cars, all these things. But really, what it is, right, is if you buy a vehicle on a loan, you get it now, right? So you can either buy a vehicle and pay $500 a month for 5 years or 3 years or whatever, and you pay all that interest, or you can save up for 3 years and then buy the car in cash, and you will have the interest you made instead of the interest you paid. And so you will literally be better off by a couple $1,000. But that delta, that couple $1,000 in interest that you made instead of paid, meant that you had to wait 3 years to have the car, right? Or you could have had the car 3 years sooner, but had less money overall because now you paid interest instead of made interest. Does that make sense? And so if you keep doing that, right? If you keep waiting and saving and paying in cash, great. You'll end up just spending less overall, and so you will have more overall. And if you're trying to build wealth, that's a great way to do it, right? And so, and if you're hoping to die someday with millions of dollars and not enjoy as much of life along the way, that's a great way to do it. If your goal is financial peace, right, and you're going through financial peace university, where that's the goal, financial peace, not wealth building university, not maximize your life university, financial peace university, then paying off your debt is an excellent way to do that. Going into tons of debt up to your eyeballs and never being able to save anything is always a bad idea, right? And that's usually, I think, where a lot of the pay off your debt, don't have debt crowd comes from, is they see too many people who can't afford to save because they have too much going out in debt. And so they're not saving 15, 20% of their income because they're paying 30, 40% of their income in debt payments. And that's a problem, right? And that's a separate issue. But for some people, it's like, well, hey, I know if once you are already doing those things, right? When you are saving enough, right? Going back to what we were talking about in the earlier segment, you have a goal, you have a plan, you're achieving that plan. You are going to be able to retire on time. You are going to be able to do the things you want to do. You're saving enough. You've got your emergency fund. You're financially healthy, and you don't want to wait 3 years for the car. You could do it now, and you'll have a little bit less to pass on to your kids when you die, but you'll drive a fun car for 3 extra years. Or, hey, we can buy the car. I'm just using the car because that's like the classic, like, go a lot into debt for it, right? People aren't really poor because they buy coffees. They're poor because they buy cars that they can't afford. But if you can, right, and some people, they could just pay for a car in cash, but then it's pulling it out, selling things, paying tax or whatever. And so it would be better to pay a couple of percent interest spread over 5 years than to pay an extra 30% in taxes in 1 year, right? And so there are different ways, if you're willing to look at it holistically, where you can get away with it and use debt and whatever else. So kind of maybe more of a nuanced view. But credit scores, ultimately, they're going to help you with a mortgage if you need to get one. If you do decide to adopt the less overall but sooner mindset, then certainly you would want a good credit score for that. But I would not focus on credit scores. I would focus on healthy habits, healthy behaviors, building wealth, building good savings habits. You're still working, building skills to increase your income, all those things. And credit score should be a distant 80th on your list of things to worry about. So hopefully that helps, Justin. And if you have questions, again, you can email them into the show, questions@retirementorship.com, or leave them in a comment somewhere, and we would love to answer them. If you have other ideas of main topics too that you'd want us to cover, feel free to send those in, and we can handle those as well. Otherwise, hopefully this has been helpful. We'll see you next week. We're here live every Wednesday, 4 p.m. Central Time, if you want to join live and be able to ask questions. Otherwise, send them in later, and we will see you next week. Cheers.